Every week, two stocks hit new lows for reasons that aren't always obvious. In this series, we break down what's behind those moves so you understand what's actually driving the market. This week, a few names are hitting new lows and there's a clear theme. These companies made big mistakes. Investors aren't panicking, they're just taking out the trash. So today, we're looking at two very different companies, National Beverage and Coty. That way, you understand why stocks fall to new lows, what red flags investors should watch for, and how to avoid getting caught on the wrong side of those moves. Let's start with Coty. Their stock has never been the same after their deal with Kylie Jenner. What did she do to them? Did she destroy the stock? Coty is a beauty company that's never really been the same since 2020. The stock hitting new lows today isn't about a sudden problem. It's about years of bad decisions finally catching up with the business. Coty tried to grow by buying brands instead of building organic momentum. The most famous example is the Kylie Jenner deal. On paper, it looked like a home run. A fast-growing celebrity brand with huge hype. In reality, the numbers never matched the story, and the price Coty paid set unrealistic expectations that still hang over the stock today. Before that, Coty made a similar mistake with its massive acquisition of cosmetics from Procter & Gamble in 2015. That deal marked the peak of Coty's stock, but instead of driving growth, it weighed the company down. By 2020, Coty was forced to sell off big pieces of that business just to stabilize its balance sheet. So today, Coty isn't a growth story. It's an acquisition and licensing-driven company that does well in fragrance, struggles elsewhere, and is still trying to earn back investor trust. That's why the stock is at new lows. Not panic, just fatigue. We need to dig deeper into the Kylie acquisition to see why investors don't trust Coty. Mistakes like this are at the heart of Coty's financial headaches. Coty paid roughly $600 million for Kylie Cosmetics, which was massively overhyped. Media reports suggested hundreds of millions in sales and a $250 million dividend. The reality? Kylie was closer to $177 million in sales, nowhere near enough to support that kind of dividend. Coty overpaid by hundreds of millions. This, combined with other missteps, pushed leverage sky high. Debt to EBITDA now sits around 3.7. Instead of funding growth, most cash goes to interest and debt paydown. The result? A company surviving, not thriving. Reported sales also look weaker because of sell-in versus sell-out. Sell-in is what Coty ships to retailers. Sell-out is what consumers actually buy. Retailers are cautious, so sell-in is down, even though sell-out is stronger. Demand is there, but revenue is pressured. The bright spot is the ultra-premium segment. Fragrance and mists are doing well. The premium segment doing well is a recurring theme we notice on the channel. But debt and past missteps overshadow that, keeping investors wary and the stock at new lows. At first glance, Coty looks cheap. The stock trades at around a forward PE of 7. They also have $300 million in trailing free cash flow versus a $2.75 billion market cap. That's roughly an 11% earnings yield. But that's where investors get tricked. That forward PE depends on heavy adjustments, and most of that free cash flow isn't really free. It has to go toward paying down debt just to stabilize the business. Once you factor that in, valuation gets tricky. By my math, it could take around 6 years to get leverage to a healthier level. After that, Coty might generate around $430 million in free cash flow. At a conservative 10 times multiple, that's a $4.3 billion business. For me to take that risk though, I'd want a 20% annual return. That means I'd need to buy this closer to a $1.4 billion market cap, or roughly $1.60 a share. At today's price, it's not cheap enough. This whole video has really been about risk, so let's go straight to the takeaway. Coty is a perfect example of why cheap stocks often stay cheap. Celebrity deals can look exciting, but they usually come with a debt that has to be paid later. When an acquisition doesn't live up to expectations, profits don't go to shareholders, they go to paying down debt. Next, let's look at National Beverage, a stock moving lower for very different reasons. National Beverage is the quiet, quirky company behind LaCroix, the sparkling water that essentially invented the category. Their CEO writes whimsical letters and they don't hold earnings calls. People love that authentic vibe. Sounds fun, right? That charm is exactly why this is a terrible investment. National Beverage had a first mover advantage and a multi-billion-dollar idea handed to them on a silver platter. What did they do? They refused to market aggressively, refused to scale, and refused to go international. Meanwhile, competitors like Bubbly and Topo Chico, backed by Pepsi and Coca-Cola, swooped in, scaled fast, and dominated the shelves. Now, LaCroix isn't everywhere anymore. When you reach for sparkling water, it's usually someone else's brand. National Beverage popularized the trend, but couldn't capture the market. They're losing relevance, and their quirky charm isn't helping investors. The big question, can they defend the brand, or is LaCroix cooked? The reason this is a pressing question for LaCroix is revenues are starting to stagnate. Their sparkling water momentum has slowed, and I doubt you've heard of their legacy brands. Even worse, the company doesn't scale or market aggressively. So while competitors pour millions into promotions and distribution, National Beverage stays quiet. The company has cash in the bank, but that cash isn't being used to grow. Shareholders are largely in the dark. There could be a plan to defend or grow LaCroix, but we're not hearing it. That's the real story here, the corporate governance issue. Nothing stands out financially, but the real issue here is that a first mover advantage was completely squandered. As an investor, earnings calls are your way to hear at least someone question management. You can get a feel for the future plans of the company. You might not agree with Elon Musk, but at least he talks to investors every quarter. Here, I think the corporate governance issue is so bad, I wouldn't invest on that alone. But when we do a valuation model, things get much worse. National Beverage trades at a forward PE of 15.8 or a 6.3% forward earnings yield. Normally, you'd combine that with growth, but growth for LaCroix has basically ended. Even if we're generous and assumed 2% growth, that's still only an 8.3% total return. The bigger problem, I don't think the multiple will stay at 15.8. With stagnant growth, investors will want a forward PE closer to 10. That implies a negative 6% return over 5 years, or a roughly 46% downside risk from today's price before future returns match the S&P. My take? Avoid entirely. Not just because of valuation, but because management isn't giving you any insight into what's really happening. So let's recap the risks for National Beverage. The biggest risk with National Beverage is governance. No earnings calls, no transparency, just quirky letters from the CEO. Investors are largely in the dark. The second risk is stagnation. LaCroix's first mover advantage is gone, and competitors have scaled and marketed faster. The brand is losing relevance. Finally, concentration risk. Without LaCroix, the company has nothing. Their other brands aren't even worth mentioning, so the business is entirely dependent on one declining product. The takeaway? National Beverage shows just how important corporate governance is. If management won't scale, market or communicate with investors, even the best product can become a poor investment. Coty and National Beverage couldn't be more different, yet they share a key lesson for investors. Celebrity deals or first mover advantages don't equal profits. Coty dazzled with influencer deals and big acquisitions, but missteps and debt mean most cash goes to servicing loans, not fueling growth. National Beverage, on the other hand, had first mover momentum with LaCroix, but refused to scale, market, or communicate. Governance failures and stagnating growth leave investors in the dark. The takeaway? Always look beyond the brand, the headlines, and the hype. Evaluate management, strategy, and cash flow. Because even the best products won't save a company that can't execute. That's it for today, guys. If you found this helpful, hit like. And since you stuck around this long, join me on Discord. Link in the description. I really do want to talk to you. Is anyone out there? Thanks. Bye.